Hi, Mike. How's it going?
Pretty good, Annie. How are you doing?
I'm doing very well. What's up in New York?
Nothing much. We've kind of had our first warm day of the year today. It is Wednesday, and what is it, the 26th, and it's fairly oppressively hot. So we're kind of getting ready for the summer. And
Yeah, it's been fairly oppressively hot in DC too. We had like a couple really gray days at the beginning of the week, but today I think it was like in the 90s.
very nice, very nice. So we should introduce ourselves. My name's Mike Konczal. I'm a fellow at the Roosevelt Institute, and I'm a blogger at Rortybomb and New Deal 2.0.
Yeah, and I'm Annie Lowrey, and I'm the economy reporter at the Washington Independent. And so what we're going to start talking about today is, just recently the Senate approved its version of the Financial Regulatory Reform Bill. And so, yeah, what's your sort of like 30,000 foot view of this? And, do you think it's gonna do the job it set out to do?
Well, it's interesting. So last Thursday, it passed the vote to end debate, and there should have been about another 30 hours, but it immediately went and passed the Senate Thursday night. I think a lot of people kind of wandered away from their computers and then wandered back, and then suddenly, we had a Senate bill that was passed.
Yeah.
So it's interesting. It's moved faster and slower than a lot of people had expected it to, and there's kind of a schizophrenic response. I don't know if you saw this, where you had half the media kind of talking about how revolutionary and groundbreaking it was, and it was a brand new Deal. Then you had other half of people saying, this was a missed opportunity. It's not going to do anything. It's, it's just rearranging the chairs on the Titanic. And as such, it was a really weird weekend to kind of sit around and talk kind of offline with a lot of the financial reformers that I know over the past year and a half. I started to get my very first emails and comments accusing me of being a Treasury apologist, which is not something that I was used to getting, given my record over the past year. So do you want to talk about what the bill does, or should I take it?
Well, yeah. So I guess also just following up on what you said about process, I think it's pretty important to note that the Senate bill's process was actually pretty weird for this. It passed out of committee in literally 20 minutes. So for the healthcare bill, they did all of this work in committee. There was this laborious committee process where they really tinkered, and people brought amendments and they sorted it out. Then they came, and there was a sort of a second process that happened on the Senate floor. But most of it was done in committee. So, but this bill, the FinReg, passed out of committee really, really quickly, and then there were just hundreds of amendments, only a few of which got offered. And it was unclear, even when the Senate finally passed it, which amendments they were going to vote on and what happened to the amendments that they didn't vote on, and what was going to be able to be done after the Senate voted. And so I think that contributed a lot of it. Eventually, the only amendments that they only followed up with two amendments, and just a lot of stuff got lost in the shuffle. So I think that sort of led to a bit of the weirdness, where all of a sudden it was like they just passed it. Harry Reid just decided that he needed the floor time for other priorities, and then all of a sudden it was over. And I agree that it felt kind of quick, even though I know that if you talk to people in the Senate, they're like, well, this wasn't actually a fast process. We've been working on this for a really, really long time. And so, yeah, my initial reaction to it is I'm a complete skeptic. I think that some structural changes as opposed to regulatory changes were probably in order. I would have liked to see something like the Safe Banking Act pass. I would have liked to see a sort of immediate institution of some kind of Volcker rule. I would have liked to see bank taxes, financial transaction taxes, some of the bigger, dumber measures, basically, to make this a less profitable industry. And so, yeah, that's kind of my initial response, is that this relies a lot on regulatory authority. But that makes it, A, hard to judge what this bill is really going to do now, and B, it makes you wonder if the regulators are going to be good enough in the future.
Right, and that's a really good summary of both what happened in the Senate and what the kind of high-level fight. Nate Silver at 538 last fall, maybe in November, said the big fight was going to be between people he called the Summerites and the Volckerites, which were people who basically wanted to kind of consolidate legal authority for regulators. And then that would be the Summerites, and then you would have the people like the Volckerites who wanted to see much more structural changes, things that involve siloing business lines, taxes, things that are very difficult to evade. It's very difficult to evade a tax, and if you're doing it, you're probably breaking the law. Where if you're massaging your capital numbers to hide from a regulator, is that a good or bad? Can the regulator even bring charges and all this stuff? to back up a little bit, we'll talk a little bit about why the Senate bill ended up as strong as it did, given where it started. And one of those decisions was that it spent a long time in committee. And this was something that was really discouraging in end of March, was that Dodd and Shelby had spent a lot of time, actually going back to last November, trying to get a bill that was manageable. Mm-hmm. This was one of the interesting things, is that there was articles that floated last November. So everyone paid attention to health care up until it passed. And there was a whole battle that went through the House that a lot of people missed. And, Barney Frank in the House put out a bill, and Chris Dodd put out a bill. And Dodd's bill in last November was widely considered to be like the more extreme bill. It removed a lot of power from the Federal Reserve. It was where derivatives ended up, actually, minus one thing that we'll talk about in a second. And then it didn't go anywhere. And then there was a huge debate about whether or not it could ever get out of committee. And he spent a lot of time working with Shelby to no avail. Shelby walked away. Bob Corker stepped in. And this was a big move. And then, they kept fighting. And then eventually, Dodd just said, forget it. I'm just going to put my bill forward and go to the amendment process. The amendment process started on a Monday, and it was supposed to go for a week or two. And I remember some of my friends who are based out of here went down to D.C. to cover it. And Monday afternoon, Dodd just said, let's go to a vote. Let's do no amendments. Let's do them on the floor. And I don't know if you remember this, but it caught everyone off guard because we were suddenly out of committee with virtually no open debate about what the bill had done and no modifications to it, which turned out to be the exact right call. The House... we'll talk about this in a little bit, but the Republicans were not particularly useful in getting this bill to a stronger place. And with the exception of one or two spare issues, they weren't particularly useful on financial reform at all. And so it was...
I agree with that.
What's that?
I said I agree with that, yeah. Keep going.
Yeah, we'll talk about what's going on with that, because I think it's both practical and ideological. But there was very... it got to the floor, kind of not finished. It was very much still something that there had been expectations that there'd be debates and amendments out. And I think those were two of the really, in retrospect, strong things that happened that made this bill stronger, is that Dodd decided to go it alone, so to speak. And then they decided to actually have a process where, senators could introduce amendments and there'd be debate and there'd be a vote. So I'll take another minute and kind of give people a heads up of what this bill does. So the big thing it does is something called resolution authority. So in the middle of the crisis, we realized that we didn't have legal powers to do an FDIC-type resolution on a non-commercial bank. So when it came time to take over AIG or Bear Stearns or Lehman and write down the creditors, there was no way to do that. And normal bankruptcy law, which takes time, wasn't really useful for this. The bankruptcy judge for Lehman, which actually did go into bankruptcy court, said, this can never be a precedence for future bankruptcies. You need a new process for this. So this bill gives us a lot of powers that can be exercised in the middle of a crisis. It takes the derivatives market, which was largely deregulated in the late 90s, and basically kind of restores kind of classic derivatives regulations to it. So you have obligations to put standardized derivatives in clearinghouses and exchanges. So in an ideal world, maybe about 70% of the derivatives market will end up with price transparency, with actual margining through clearinghouses to make sure that no one is suddenly caught off guard one morning saying that they are not able to make their margin calls on derivatives. Then the last part is to increase consumer protection. Or the third part is to increase consumer protection, which is in part a consolidation. It takes the half dozen agencies that have some exposure to maintaining consumer laws and puts them under one umbrella. In the Dodd bill, we have the Federal Reserve. In the Frank bill, which this will be a debate for committee, it's in its own agency. The first new government agency since the 70s, which is kind of amazing in some ways. It's almost got out the door. And then the last stuff is stuff like the Volcker rule stuff. Ratings agencies, well, the Volcker rules in the Dodd bill, and that splits off proprietary trading. And it's kind of a blunt rule, and we've got a lot to talk about, but it's under regulator kind of scrutiny at this point. And the last stuff is kind of, I don't want to say miscellaneous because it's very important, but ratings agencies reform, securitization reform, at which point it more or less ended up looking like the House. So,
sure.
So what is your take? What were you happy with what you saw, and what were you not happy with what you saw in terms of those pillars of what the bill was supposed to do?
So I think the way you describe the bill is really, really good, and I'll just apologize. I was sitting over in my sitting room, and like the sun is setting, and it was just getting in my eyes. So just had a very weird blogging heads experience of like actually moving my computer and myself. So we just went like on a tour through my apartment. But anyway, to the point at hand, I think that you're right that if you think about the bill as doing stuff sort of like before a crisis, during a crisis. Before a crisis and during a crisis. I think that the stuff that it does during a crisis is really, really good. So a lot has been made of what Republicans referred to as the bailout fund, which was in the Senate bill, this $50 billion resolution authority fund, and in the House bill, it's $150 billion. And this was one of the things where the politicking over this just got really, really ridiculous. Like, in no way was this the guarantee of any sort of bailout, because basically the Dodd bill says if your company is determined to be risky enough that, the government decides to liquidate it, it sets out a pretty clear process. And, shareholders, I guess like equity holders are wiped out, management is fired, counterparties take a haircut. It's straightforward and it's strong. I think that the things that it does before the crisis, things like the Volcker rule and the way that it sort of structurally changes banks, I think that's where I'm not totally convinced that this is going to do enough to prevent the next crisis. Obviously, it's really, really hard to say where the next sort of financial tremors are going to come from, where bubbles might form, like as a more philosophical point, there's like basically no way to say that. But in terms of making banks less risky, what this bill does is gives regulators a lot more authority to sort of make determinations that banks are risky, and then to do things like impose higher capital requirements, or to make them change their leverage. And as you pointed to, it can be easy for companies, or the worry is that it'll be too easy for these companies to basically like evade regulators, that there'll be too much regulatory capture. So that's really where I'm worried. It's not like during a crisis, it's before it. Like, what does this bill do to prevent crises? And I'm just not sure that it does enough. What do you think about that?
No, I think that's really accurate. And what you saw, and this was kind of the disagreement a lot of people had with everyone, was I wrote, in some formats, I think I wrote at New Deal 2.0 and a couple other places, I was like, this is a good bill given where it was 2 months ago. In fact, in some ways, it's a really good bill given where it's 2 months ago. Like, I kind of didn't expect to cover it. I was almost wondering if a bill would even get out. People would say, that's, an apologist and yada, yada, yada. And it's like, well, this is kind of what the bill was meant to do all along. Like, there was never, with the exception of the Volcker rule, which came in, when was that? That was after the Brown election. It was like 2 days after the Brown election. So what is that? Mm-hmm. January? February? Whenever that happened. So maybe it was March. I think it was March. But earlier this year, we had, there was a move to kind of spin out the prop trading desk from commercial banks.
Yeah.
But before that, the approach was always this kind of, this kind of let's get regulators more powers. The Obama team is essentially technocrats. They believe in the regulators. They believe they just weren't doing a good job this one time, but they'll do a better job next time. Mm-hmm. The administration is kind of filled with people who are in those roles. Timothy Geithner from the New York Fed is the most obvious example. Mm-hmm. So you had a problem where people were fighting in the Senate to kind of bring in structural changes, mm-hmm. but it wasn't clear what they were fighting for. And Tim Fernholz just had from the American Prospect had a blog post to this effect that said, in healthcare, there's a lot of fighting between people who were happy with the approach, wanted a stronger approach, trade-offs, but we kind of knew what like a single payer of healthcare looked like. We didn't mm-hmm. quite have that for financial reform. We didn't know what the reaches were. And, at Roosevelt, we put out a report, Make Markets Be Markets, which were kind of like trying to get an idea of what are the reaches for this bill? What does a really great bill look like so we can mm-hmm. fight for it? And, we got some of those stuff and we didn't get other parts of that stuff. But to go even further than that and say, what are the kind of structural changes we want? There wasn't a whole lot of like agreement or necessarily like concentration on the big reaches. The most obvious one was something you brought before that was the Safe Banking Amendment Act, mm-hmm. which would have been a liability cap on it would have been a cap on non-deposit liability. So it would have essentially taken top 5 banks and turned them into the top 13 or 14 banks. Mm-hmm. And the Treasury, there's just this, did you read the piece in New York Magazine? We'll put a link to it, but there's a great piece about the relationship between Obama, Treasury, and Wall Street, and essentially voters as well. That was just a really remarkable piece. And the idea is that like, Obama and someone just can't understand why Wall Street is so opposed to him, given that this is not really harsh changes. And, they're incredibly angry. And I think they're angry for cultural reasons, that they're not at the center of the next American industry anymore, that they're kind of thought of as this, kind of albatross on the real economy all of a sudden, on the real economy's neck all of a sudden.
Yeah, and I think that they're thought of as doing precisely the opposite of what they should have been doing, which is like allocating capital to sort of like foster economic growth, right? And instead they're seen as, this kind of like Shiva-like force of destruction in the U.S. economy that basically just like sucked the home equity out of, average sort of like middle income Americans and, got really rich in the process, and now is like whining that they need to be regulated like other industries. Yeah, I think that they really couldn't have controlled the narrative here. And I agree. And I do. The piece is really good. I highly recommend it to people. And it's a pretty fun read.
Yeah, it's like the finance economy has like one job, and it's to take money and put it where it needs to go. Like that's like its one job. And it failed miserably. I mean, it created trillions of dollars of absolute garbage that we're all not going to want in 5 or 10 years. And it's like but it's like a remarkable failure. And it's one of those things that the crisis happened so quickly, and a response to it was so well done. Is that it on some level, it's almost like being treated in the popular consciousness, or let's say the DC consciousness, as like kind of like just like a policy problem. That's, there was a pothole, we needed to fill it, so we hired some guys and we filled it. Like it's not an actual like concern about this way that we prioritize the structures of our economy. So in that way, it's kind of very worrisome that we kind of feel like, okay, so we filled the pothole, now we can just keep on going. So
yeah, whereas that's not true. And you've done some great blogging about this recently, and it's something that I agree with you with and I'm very worried about, is like, what does this bill do to prevent the next crises? And and which some people insist is coming as soon as like 3 or 5 years from now, right? That there's going to be some massive credit bubble fueled by low interest rates, and we'll be back here again. And I don't think that that's right. I think that we hopefully have longer than that. But so the main thing that the bill does is it gives new regulators authority to sort of like look for and stop bad practices. But you were pointing to some ways to know that this bill has worked, and some things that also need to be fixed in order to make the bill better and in order to make the economy safer. So do you want to go through some of those?
Sure, absolutely. So one of the other dynamics that was frustrating throughout this whole process is that there was purposely some cynical reaches that were walked back. So the one thing you brought up was the resolution fund, which I thought was a fantastic idea, because
I thought so too.
It's countercyclical, so the money is raised when things are good and paid out when things are bad, which is how insurance should work. I mean, you shouldn't pile on debts in the middle of a crisis. Like, the market will freak out. It is a tax on bank size, which, we've heard that the tax is coming any day now, and I will see it when I believe it. And a bunch of other reasons.
And it's just like a tax on banks, full stop. This money in the House bill and what used to be in the Senate bill, this money was coming from banks. It was going to have to be that like Goldman Sachs was going to have to write $1 billion check every once in a while to like go get put in a fund. And there's nothing like that as far as I can tell, in the bill as it is.
No, nothing at all like that. But it's important to remember that when we saw this get introduced into the debate in the House, and Treasury was very much against it. Luis Gutierrez, the representative from Chicago, from Illinois, fought for it, and he got it. And then so as soon as it showed up in the Senate, and as soon as McConnell started to flag it, Treasury could seem like they were walking back an idea that they really fought for. And that's how it was actually played. But that wasn't true at all. Like, it was always a very contentious issue for the White House. Progressives really had to fight for that in the House to get that. And so it was very disappointing to see that get lost. And there's a bunch of other things. There's a 15-to-1 leverage cap. So, regulators have discretion. That's a good thing. I mean, they often have, smart things to contribute. But you want some fencing on this. It's important to remember when you think of coming out of the New Deal, a lot of this stuff ran on autopilot. There was strong fencing where, the damage would be contained. And that the 15-to-1 leverage cap helps with that. And that's not actually a radical notion at all. Canada, which is very concentrated, and a lot of people talk about as a potential role model for our economy, financial economy, has a 20-to-1 leverage cap, for instance. And that snuck into the House bill. There's actually a great piece by Ryan Grimm on that from Huffington Post last fall. That literally snuck in, like the vote, like no one knew that the vote was coming. So that's how it got done. So that is missing. Some things that strengthen resolution authority that allow us to allow regulators to take a hit to secured creditors. The Miller-Moore Amendment in the House was missing. And, obviously the CFPA being its own agency is missing. So it is a good bill.
It is, and we should clarify that kind of what happens now is, at least technically, and conference is kind of like a weird. It's like sort of a little bit of a weird process. But basically the rule is that nothing that is not currently in the House or Senate bill is on the table anymore. They can't create stuff. There's processes that they can go through to add it in, but they can't really do it in the conference committee. What they'll do now is essentially split the difference or pick the better measure from either thing. So the 15-to-1 cap, because it's a leverage requirement, because it's there in the House, it could hypothetically be in the final bill. And the concern now for progressives is basically that, you're going to pick the more loopholed, crappier part, piece of all of these bills, which actually they are pretty well aligned. The differences aren't enormous, and the differences certainly aren't philosophical. And that you could end up with either a really, really strong bill or a significantly more weak one. But, the major architecture of how this works, stays fundamentally the same.
Yes, definitely. The one thing that everyone's expecting to go is a controversial provision that was put in by Blanche Lincoln to take derivative dealer desks and pull them out of commercial banks. So this was, I think, the other third game changer. One was Dodd's decision to go it alone, which caught people very much off guard. And then the other big one was Blanche Lincoln's primary challenge being very successful, in fact, forcing a runoff to June 9th, which is why this language is still in there. So when Blanche Lincoln needed to look very tough on Wall Street, she put out a derivatives language that was significantly stronger than anyone had expected. And so it took derivatives to a good place where it needed to be. And it also took this thing where it basically recreated Glass-Steagall as it would be envisioned right now and took the dealer desks out of the commercial banks. It was a very controversial provision. Very few people expected it to stay, even people who supported it. But the primary challenge kept going, and Lincoln was, Dodd put forward language to withdraw at the day of the primary, and it went to a runoff, and so it stayed. They had to withdraw that. So that, the three big kind of, the two big kind of pullbacks that were fairly cynical and actually I found very distressing was the derivatives pullout and then the kind of resolution fund. I found both of those very surprising and in the kind of flagrant way that they were kind of put out there and then walked back for a concession to kind of control the narrative.
Yeah, and without a vote, and I guess we should just clarify that Lincoln's thing is gone. The spinoff is out of there.
Is that true?
I mean, at least I think it's essentially understood that that's not making it out of conference. It hasn't happened yet because they haven't started doing this yet. But Barney Frank has said that it's that the sort of Volcker rule language that's in the bills is enough, and therefore Lincoln's sort of very specific language making commercial banks swap out these spin off their swaps desks. That's out. So I think that I actually come down on the side of thinking that that's not a big deal as long as the Volcker rule is actually instated and works appropriately. But do you think that, would you have argued that Lincoln's language actually really does markedly improve things?
It's interesting. It markedly changes things. It is a game-changing piece of legislation, and it does serve a function that I understand. It's interesting because, on one hand, it exposes a lot of worry about the bill because the obvious thing, the people who are against it are saying, the dealer desk will then basically be spun off, but there'll be these unregulated shadow banks that everyone's going to be freaked out about because they're dealers. They still have a liquidity problem and. they won't have people, watching them as if they were in a commercial bank. But the response is like, well, they'll still be defined as a major swap participant, so they'll be obligated to be regulated under the derivatives language, right? Mm-hmm. And then you kind of get this eye roll that's kind of like, but yeah, as if like, well, yes, but we don't really trust that language. Like, it's kind of like the hint about it.
Right.
So it's like, it's better to keep it all together so we can keep an eye on it all at once. But it's like, well, that's fine, but there's also other problems with that. That said, that language came out of nowhere. So there was very little study or like languaging done on it. I mean, it caught supporters very much off guard, mm-hmm. which is why I kind of thought it was cynical to kind of put reformers in a place where they had to defend something that it was clear the senator herself was not a fan of. Like, she couldn't explain it to people and stuff like that. So.
Yeah, and it did sort of come out of nowhere, and so I guess that this is the one thing is I'm expecting that will be gone, but the Volcker rule in some form or another, which basically says, I mean, the kind of like layman's terms way to explain it is basically to say that if you're a commercial bank, which means that you sort of like take deposits, your average sort of Main Street banking institution, you can't be betting with your own money at the same time. So a bank like Goldman Sachs, which isn't depository, will sort of like lose its backing from the Fed, which will, at some point in the future, and it can proprietary trade all it wants. But, it's not clear that other banks will. And that for some banks, this will cause, I mean, hypothetically, it should cause pretty big structural changes.
Right. Yeah, no. For a couple of the big players. And I think ultimately what we'll see is that 716 is traded for something like stronger Merkley-Levin language that was left out of the Senate for a vote.
Right.
I think ultimately that's the strong play, and I think that's what will ultimately happen. So.
Yeah, and the Merkley-Levin language, it seems like they're pushing for that. They released a letter today, sort of like tartly requesting that make it in there. And so I think that we'll probably see that. So just sort of like since we discussed the bill at this point, what do you think that looking forward, how will we know it's working, I guess? And what do you think that you're still worried about that isn't encapsulated in there?
Well, so it's kind of interesting to step back and think, okay, so was this a successful endeavor or not? Like, can we say that, given that we had a weak economy, given that we didn't have a lot of things ready to go out the hopper in terms of ideas and plays, a year and a half or two. In 2007, people weren't spending a lot of time thinking about how to reform the financial sector in the mainstream, progressive movement, or really even the conservative space either. So,
no.
And it's interesting. Like, this is. So I was very frustrated with it at points, and I'm ultimately kind of disappointed in what had happened. I think Treasury could have moved the safe banking amendment. They say as much in the New York Magazine article.
Yeah.
And there was no interest in doing that. There also wasn't really any interest in doing anything big with it. It was very much a kind of technocratic, like, let's trust the regulators and the Federal Reserve in between. And I think that this is a space, given that my theory about Obama is that this is kind of the beginning of a longer, progressively minded generation. And we don't know what it will look like and what kind of values and political goals it will have right now, but we kind of have some senses. And in terms of putting forth a progressive ideology that works, historically, progressives do financial reform very well. The New Deal is something that had stood very good until 1980. Until stagflation essentially happened and Regulation Q and all kinds of other stuff started to roll. It's, the idea of worrying about concentrations of corporate power, about the government's role in enforcing transparency, about, broad access and prosperity, and, in general having finance works in some sense like a utility to build the real economy. These are all progressive values and progressive goals. And they should be at the center of any endeavor like this. And, sometimes they were, like the CFPA was very much about broad prosperity, but, some others weren't. Mm-hmm. And the conservatives particularly don't have a good answer for this. I mean, there's the core group of the conservative movement, evangelicals particularly aren't interested in money lending. Your kind of mainstream businessmen are kind of freaked out with how powerful and rich Wall Street got very quickly over the last 20 years. And, frontier libertarianism is very much about the gold standard and like state currencies and these kind of Ron Rand Paul ideas of ending the Fed. And like they just don't speak to, they speak to a 19th century economy. The banking sector of 1870, you hear that a lot, and they blame FDIC. And even their responses aren't particularly coherent to a financial reform agenda. I mean, they're worried about, community investors bullying Goldman Sachs, which is, like CRAs. It was such a red herring from the door. It didn't understand that there was a credit bubble across the entire economy.
Right.
So let's take a quick minute and talk about the idea of the left-right alliance on financial reform. Because you had a lot of people say, libertarians and socialists or libertarians, like Bernie Sanders and Ron Paul got together and, decided to audit the Fed. In general, I didn't see anywhere near as much movement as I had expected. People like, T.P. Carney of the Obamonomics crew. Like, I didn't quite see an overlap there as much as I did. And the two things, I think there was some overlap on the ratings agencies, understanding how the cartel there was very destructive and showed up in a variety of different ways. Mm-hmm. And in auditing the Fed's books over the past several years to make sure there's some transparency given to the way the bailouts were handled. But in general, I didn't see a lot of movement on the conservative base, or even the conservative, kind of intellectuals. And I was curious as to what your thoughts were on that.
Yeah, I mean, so I think that it's funny because Wall Street, at some point there was this sort of interesting change where they stopped calling this financial regulatory reform bill and started calling it the Wall Street bill. And I was kind of interested to see that didn't get more conservatives to come and basically, if you think about the problem of sort of stagnant wage growth and real economic hurt in lower income and middle income Americans for the past decade, it's not a partisan problem at all. You can talk about partisan solutions, and I think that, this is why Republicans were kind of obsessed with the language of bailouts, right? They're obsessed with the fact that Fannie and Freddie for a really long time had sort of privatized profits, but were essentially given this implicit guarantee by the federal government, and it ended up that the federal government is just bailing them out. That Republicans became basically just obsessed with this language of bailout, that it was the Obama administration that didn't really socialize these companies, instead just, funneled them tons and tons of cash at the expense of Americans, and they never quite got past that. I think that there was a way in which Republicans could have come and really productively worked to say this was economically destructive on a $1 trillion scale, and that, companies do need to, if they're dangerous, they need to be regulated. And I agree with you that I'm a little bit shocked by the lack of sort of firepower over there. That so much of So many Republicans, and I shouldn't say all Republicans, but a lot of Republicans ended up focusing basically on the government's actions as opposed to the bank's actions. And so I think that was actually it was a bit of a failing on their part. And it is kind of interesting because, again, I think that, Wall Street is just reviled by most of America right now. And it would have been, easy to score political points to basically say, I am doing this for you, local people. We're making sure that these banks are economically productive in some sort of broader sense. And interestingly, I thought it was, this is why I think to get back to the sort of point about why aren't we taxing banks? Or by, either by the sort of resolution authority fund that would essentially transfer money, like you said, would sort of tax them in good times to be used as an insurance policy during bad times. That's one place in which I really wish that we would have seen something. But yeah, the process it was kind of one-sided, and I think it'll be interesting to see what the final bill looks like. I think that on the consumer protection side, it's actually really, really strong. And on this kind of structural side, I think it remains kind of a question mark. And as to whether we're ever going to know whether it's really working, I think that at some point you're going to have to see banks actually sort of change, right? At some point they're going to have to stop proprietary trading, which is going to sort of alter the landscape. One thing that I hope that this would have done, but isn't, I don't think that it's going to increase competition among investment banks. And you can look, I know last quarter Goldman Sachs was making sort of 27 cents on the dollar which is just really a lot of money for a company in a hypothetically competitive market to be making. So, I would like to see them become a little bit more economically productive and a little bit less, frankly, financially profitable, and I don't think that we'll see that. And so I'm not totally sure that I know what success would look like for this bill for me, because I do think it's true that, you can't sort of prevent crises from happening. And my hope is that this bill would be pretty good about making the bill, sort of making the damage less when it eventually does happen.
Right. So yeah, that's a good question. So like looking forward the next couple of years, like what is on the plate with financial reform? Can we put aside the Twitter hashtag that annoys everyone and actually like move on to new topics? Well, I see kind of three avenues for the way financial reform is going to play out. And one is the way you just brought up very well. That was monitoring. Like, is this bill actually working? And can the public and the press have some means to know success from failure?
Yeah.
Part of it will just come from leverage ratios and whether or not these banks are holding more capital, if they're less profitable, if they're, if various risk metrics that, there are ways to understand, and make public and, communicate on now that people are interested in them. Are they working? Are they, are these firms stronger and based on better capital? Mm-hmm. There's also the market implication about whether or not they're getting funding cheaper on the implication that they will get bailed out. And this is a big thing for the ratings agencies because they're watching this factor. It's also just a thing for the capital markets in general. It's like, well, will creditors to Citigroup ever take a haircut ever? And if not, that sounds a lot like the GSEs and Fannie and Freddie. And, that was a disaster the last time we had that.
Yeah,
and the worst case scenario, I'm sorry to cut you off, but the worst case scenario for this bill is that we've kind of, created 4 or 5 Fannie Freddies. This was the main reason I supported the Safe Banking Act, was that to take that, catastrophe scenario off the table.
Right. And just to kind of like unpack what you were mentioning about the credit ratings agencies, just because this is basically the ratings agencies have said that once the final bill comes through, they're going to re-rate all of the banks to determine and possibly basically say that the banks are like a little bit less financially safe than they were before. The bank's sort of like cost of funding goes up. And banks are like actually very, very terrified about this. And I think that this is kind of funny because I am like totally disgusted with the credit ratings agencies. I wish that the like Dodd bill, I guess we can't call it the Dodd bill now. We can still call it the FinReg bill. I wish it did more to reform their business because I think that their business is terrible. And I actually find it like kind of funny that that people still take them so seriously or something. I know that like they perform like a really important economic function and will continue to do so. But and like having your rating changed can cost you sort of like billions of dollars. But yeah, so that's what they're concerned about, and I do think that will be interesting to watch. And I don't know, I actually don't know this. When does so with like the proprietary trading stuff, they say basically that government has to study it, and then kind of like a year from now determines how banks should do this or something. Do you know the timeline on that?
It's 6 to 18 months. I've forgotten it.
Okay.
But it's some like time frame. So there's like 18 studies in the next year. Is that right? Or the next 2 years? There's 18 studies.
It might even be more than that, right? Well, I guess we don't know until the final, but yeah, right. There's like tons of studies in this bill. There's tons of like recommending that the government look at things and then figure out what to do.
I will blog the list of studies unless you want to call that. We'll just make a list and get it online.
I will link to it when you blog it. And it's funny to think that they're going to have to like hire people to do this. I wonder who they're going to get,
Yeah, the ratings agencies probably. No, actually, no, hopefully not. But yeah, the GAO has to do 11 of them, and it's they're already kind of overstaffed or understaffed. So
yeah, they are. I hope the government gives them more money. And then we sort of started talking about this, and I know that this is an issue it's an issue that interests us both. Is that the next big thing that's coming up in terms of like the financial landscape is they're going to reform Fannie and Freddie. They're going to figure out what to do with them.
Mm-hmm. Do you wanna explain some of the issues on the table? It's weird.
Yeah, I'll take a stab at it.
I'll prep the audience to say Treasury had an announcement in April that basically said that they had no idea what to do, and their big plan was to ask the public 7 questions. I just posted them to Ezra's blog where I'm guest blogging this week, and you look at it and you're like, we really don't have our arms around it, like at all, like what to do. So why don't you give it a shot as to what some of the problems are?
All right. Well, just super 101, very quickly, I feel like it's always good to clarify what Fannie and Freddie are and what they do. Because, like, if you ask somebody on the street, you're like, what are Fannie Mae and Freddie Mac? I think that what they would say probably is that they are mortgage originators, right? They give people, probably like low-income and middle-income people, mortgages. And sometimes they gave a lot of subprime mortgages where people only put like 1% or 3% or no percent down. That's not true. They are basically the secondary mortgage market, which one way to think about it is that they take like the sort of global capital. So there's lots of money sloshing around in investors, and they make it so that capital is accessible to little banks that actually do originate mortgages. So they buy mortgages, they turn them into mortgage-backed securities, most of them, and then they hold on to some other ones. And they do that for about sort of like 80% of the mortgage market. They do it with what's called conforming mortgages, which are just mortgages that are like less than, I think it's like $450,000. It's some amount of money. And then they sell those sort of like mortgage-backed securities to investors with this kind of like the investors pay them like a fee, and Fannie and Freddie say, well, if this mortgage-backed security goes south, then, we'll cover its losses or whatever. Mm-hmm. So this is total, utter catastrophe. They have lost $145 billion, which they have had to take from the Treasury. They were effectively nationalized. They're in something called a conservatorship right now. And so Fannie and Freddie were these government-sponsored enterprises, which is basically Lyndon Johnson, to get them off of the government's books during the Vietnam War, turned them into kind of like private companies with a sort of implicit but not explicit guarantee that the federal government backed them. And also they have this monopoly. They're the only players in this mortgage market, which for a kind of complicated reason, they can just do it cheaply. And so no other companies compete with them. So they're just a huge mess. They're a very, very big mess. And the losses that they're taking right now, they're still performing this function of securitizing things, basically. And they also hold a lot of mortgages themselves, too. And the issue with Fannie and Freddie is that the government, I think the one thing that both Democrats and Republicans and Treasury know is that Fannie and Freddie will not exist when this is over. They will probably get rid of the names Fannie and Freddie because they hate the names so much now. But they're going to turn them back they're going to take away this kind of strange structure that they have right now, which is just taxpayers are just eating losses from the housing market. And so, you're right, that nobody quite knows what to do with them. The Republicans it was John McCain and Judd Gregg and somebody else, I think it was Richard Shelby, put together this plan to sort of just end the conservatorship of Fannie and Freddie and turn this into not a government function, but a private market function. Problem is, if you do that too quickly, all of a sudden you force mortgage prices to go up and you kind of like crater the U.S. housing market. So people are now starting to look kind of rigorously about how basically other companies can come compete in this space and how to stop Fannie and Freddie from just eating up a lot of taxpayer money. And it's really, really complicated. And it was. The Treasury guidance was pretty hilarious because it comes to this sort of broader question of like what Fannie and Freddie are and what they should do. And so one other kind of weird thing about Fannie and Freddie is that they have sort of this guidance from the federal government that they also have to sort of like make sure that low-income families get loans. So that function will probably go. They'll probably also not be able to hold mortgages anymore. They'll probably just be players in the sort of mortgage-backed security market, but they'll also lose this sort of special charter status so that the federal backing will become explicit. And instead, other companies will be able to come in and compete with Fannie and Freddie and apply for that same status where if they pay the federal government some amount of money, they will also be able to work in this market. So that's kind of the basic point. But it's a really complicated issue. It's hard to explain. I think the politicking over this is going to be really interesting because I don't think Americans understand what this is, except for Fannie and Freddie just being like an open drain into which the Treasury is just hosing cash.
Right. That was a fantastic 101 explanation. What's kind of important to realize is that, like, you talk a lot about, like, the natural market or, the state of nature market, and economists like to think of, like, these things equilibrating without the presence of government. But the idea of mass, and by mass I just mean, like, a sizable amount of people owning mortgages, like, over, some, not a high number, but just a moderate number. And more importantly, being able to build equity wealth through them is a really historically new phenomenon. Like the idea that, mortgages before the New Deal were very, they're 50% down, 5-year bullets. The idea that you would use it to build wealth through, or, that you would slowly pay off a fair amount of principal is like it didn't exist. And it didn't exist. And, and it showed that when you kind of went off this grid through subprime mortgages, you also had something that was very difficult to build equity in. It had something where, you were kind of always near the edge of being underwater. And, a slight downturn would wipe you out, as a quarter of Americans found out in the past 2 years. So, and, every major industrialized country has some sort of housing policy that sets up fencing for this. The Danish are people who talk, people talk about the Danish mortgage model quite a bit. And, where it's very standardizable and it's very easy to kind of swap in and out your debt and buy it back. And when downturns, that the people will look internationally. But, these things are always kind of there and how to set up the baseline of that market. And so I think it's kind of interesting to make sure that people are held to that kind of standard that says, on some level, in the 21st century, do we expect, half of Americans to own their home?
Yeah.
Or half of Americans to own their home in a way that is an investment for them, that builds equity for them. And, if we just kind of throw it to the wild, if we basically say, it's a free-for-all, but we'll subsidize housing, that's going to be a perfect transfer to banks, of taxpayer dollars without any kind of wealth building among average Americans, or at least that is my quick take on a quick survey of the literature. So that is definitely something people need to watch over the next year, is how the GSEs are reformed. And that, I think, will come to a head probably. And it's something that is the one place where I would see conservatives and liberals kind of, having a lot of overlap, because I think there is both sides understand that something needs to be done, and it's just a matter of what kind of subsidies and how explicit they are and how much fencing you're providing. So.
Yeah, and what I think is interesting, and people should go read Donald Marin and what's the other guy's name?
Philip Swaggle.
Just put out a paper looking at how they would reform Fannie and Freddie. And there's a fair number of these papers out there. And I think that there's starting to be kind of like this convergence around the idea of what we're going to do with these things. So I agree with you. And again, I think that for political reasons, basically because reforming Fannie and Freddie, it's like pretty hard to explain it to folks. And therefore, I think that the politicking over this could go one way or another. I think that actually, as a fundamental sort of principle, Republicans and Democrats aren't going to be far on this. I don't think so. I think that, probably both sides agree that there's some role for the government to subsidize housing for people in low and middle income for the purpose of, like, kind of wealth building and to sort of participate in this economy. And there's a lot of sort of, like, historical issues about that, historical political stuff. But I think that, the issue will basically become, I can imagine that if you're a Republican, what you're going to do is you're going to say, well, the Democrats are just going to bail these guys out. And so I agree. And that's why I think that, like, fundamentally both sides will agree that they're going to kill off Fannie and Freddie as they are, in the sense that they're not going to wind them down. They're just going to, like, they're going to make them private again. And also what they're going to do is they're going to take this kind of, like, this mandate to provide housing to low and middle income people, and they'll just move it out of Fannie and Freddie. They probably shouldn't have been doing it in the first place. They shouldn't have had that mandate. And they're going to push that into other parts of the government. And, notably, Fannie and Freddie aren't the only sort of like federal housing programs. They have like the federal home loan banks. They have a bunch of other stuff that they can do that with. So I think that you're starting to see this kind of like pretty broad architecture. And the issue is going to be, and I would be interesting to hear your take on this, that some people are worried that basically the federal government's saying that they're going to start pulling support and not accepting losses from Fannie and Freddie at all anytime in the future will kind of like spook the mortgage market. And the housing market right now is like so terrible and is sort of teetering on the precipice of kind of a double dip. In some places you still see declining home values, in like Arizona and in Nevada and Florida, California, these states, the sand states, as well as Detroit. It's so sort of delicate that they just don't want to really like touch this yet. And I think that actually, it seemed to me that earlier this year that was the big issue, is they just didn't want to deal with it. Whereas now it seems like they're ready to say that, like, as of the next Congress, after the elections or whatever, they're really just going to do it, because it's just like such an utter big mess.
Yeah, definitely. So one other thing is that one of the reasons you're seeing the government kind of out of control in this space is that Fannie and Freddie ideally should be a liquidity provider. So they should almost be like a Fed discount window for the mortgage market, which is to say the moment where, Chase or JP Morgan or like the major banks basically say we will no longer participate in the housing market because our books are toast and we can't touch anything and we need to kind of just heal our books, like what's going on right now. Like we're basically not going to do any lending, and where you have other means, basically right now for our purposes, the private securitization market is so fraught with a variety of things, not least of which conflict of interest, and people are worried they're being scammed, and the ratings agency problems, and et cetera. So the securitization market's a problem. So there's no way to get capital to homeowners. This is exactly where Fannie and Freddie should jump into the breach. I mean, this is the point of the government here. It's like, it's like basic Keynesian stuff. It's like, the government steps in to provide aggregate demand. Fannie and Freddie should go into the breach and start handling the mortgage market right now. The problem is they got toasted in the credit cycle leading into here. And there's no one to go in that space except FHA, was it the Federal Home Administration, which is not a liquidity provider. And you wrote some interesting stuff about how FHA is basically just bleeding right now because they're being forced into the spot that they just don't have a functional role in. And we're starting to run a little bit low on time if you want to talk about that for a second or two.
Yeah. So and I think that the easiest way to put this is right now, without the massive federal government interventions into the housing market. So, recently the Fed stopped buying mortgage-backed securities from Fannie and Freddie, but they bought like 1.1 trillion of them. They bought a lot. And then you have Treasury just funneling Fannie and Freddie as much money as it needs. They've said that they're just, Obama last winter, I think it was December, lifted the cap on losses on Fannie and Freddie, and basically just to assure the market that government was standing behind it. And then just recently, and we don't have data as to what happened after this, but very recently the homebuyer tax credits expired, and so Inside Mortgage Finance? Is it Inside Mortgage Finance or Inside Mortgage Data? They basically said that Fannie and Freddie were backstopping 96% of mortgages. And before they were backstopping sort of like a lot also. Even when the housing market was kind of comparatively healthy, they were still doing that for 40 or 50%. But you're going to continue to see that kind of, it'll be interesting to see what happens to the housing market, which I think that there's a not inconsiderable chance that it'll double dip once these programs expire and the housing market kind of has to teeter to stand on its own legs. And like you pointed out, credit remains like really, really tight. No bank wants to be out like sort of like making mortgages again, but at some point they will. At some point housing program, like the interest rates will be so low and housing prices will be so low that the market will just kind of like teeter back to some sort of like sense of stability. And there's some signs that that's happening, right? That things are sort of stabilizing, that housing prices have dropped enough, and mortgages are cheap. And basically the sort of other macroeconomic thing that's going to have to happen for things to be okay is unemployment. Big issue right now is, if you're unemployed, obviously you can't pay your mortgage. There's a really high rate of foreclosure. That puts your house back on the housing market, which depresses home prices. Like, it's this very horrible, vicious cycle. And so if unemployment sort of kind of normalizes and the housing market normalizes, I think that reforming Fannie and Freddie will be a lot easier then. If it doesn't, if housing gets worse, the losses to Fannie and Freddie will be worse, and it'll also be harder for the government to do anything in the short term about them. So that's my quick take on Fannie and Freddie. But it's going to be interesting to watch, and it's another really big, really, really complicated bill. So it'll be healthcare, then FinReg, and then Fannie and Freddie. And Fannie and Freddie, I think, has the potential to be sort of just as fraught as both of these. It's easier because it's the government just regulating itself, sort of. Mm-hmm. But it's going to be pretty contentious, I think.
Yeah, and I wonder, every time I don't think that we can make any more advancements on regulating the financial sector or financial transaction tax, I think about how the next 2 or 3 years is going to be primarily characterized by the slow bleeding of the American homeowner. I mean, it's something I wish was not the case. I wish there was more defiant action taken earlier. I wish the government would have sledgehammered the second lien issue and a bunch of other stuff that they decided very consciously not to do around the time of the stress test last year. But yeah, I mean, you're going to have, delinquencies keep going up, though foreclosures are basically capped at this point. I don't know if they've hit a structural limit, if they're just putting it all in shadow inventory, or people, Lord knows what's actually going on. But, it's going to be another painful couple of years in terms of American home ownership. So that should finish up financial reform. So the battle's not done. So we have a few minutes left. What else would you like to talk about?
So, we could go into the sort of more depressing issue of what's happening in the Gulf with BP.
Speaking of the slow bleeding of things that are important to our world,
speaking
the ocean,
about things that are totally terrible, I was looking today, and I wonder if you have the answer to this, because I've been trying to figure it out, and I was flipping through my version of Daniel Yergin's The Prize, which is a really, really good book. Why does BP own that oil? Why is oil in sort of national waters allowed to be owned by a British oil company?
So I think I know this.
Okay.
This is tough because I'm going to go with what I heard on the Rachel Maddow show. So I believe this is true. Is that is our oils, the people, but they pay a fee to drill it and then they reimburse us for it. So they give us a small amount of money per barrel they pump to get to it. So it's obviously a very favorable deal, but it's something that they still pay per gallon for, because there's this big issue about whether or not they should be paying the American people for all the oil that's being spilled out.
Yeah, because it does seem like they should. And I'm actually sort of, because I was trying to look into what other countries. Are we rare in not having a national oil company? Because it seems to me that it was just that sort of Standard Oil got in there before anybody else could, and before the United States realized how much oil it had, and then it just the Rockefellers owned it or whatever. But I'm sort of interested by this history because the BP disaster, I mean, it's terrible, and I hope that I'm so incensed that Inhofe prevented them from taking off the liability cap. I thought that was terrible. It seems like they should be paying for the oil of ours that they're just dumping into the Gulf of Mexico.
The question I have is, how do you really calculate the economic liability?
You can't, yeah.
I mean, it went back to a lot of the debates that you saw with global warming, where people are it will only cost 1.854% of GDP, and it's well, how do you actually put a price on this? Obviously, you can say, well, there's these shrimp boaters and their value was X over 30 years, and you can discount it and say, they need to be compensated this much. But as a practical level, the sheer amount of essentially, health issues, ecological and environmental degradation. How do you actually price that? So, the liability, cap, it's a secondary issue. The fact that it's just it's obviously a first issue, but, how do you even calculate, is it 20 billion or 30 billion? And I mean, I'm sure there's people who can do that, and they probably have a very complicated formulas and a lot of thought put into it, but it's just, when you kind of sit back and someone says, well, it's only $10 billion worth of damages, no need to freak out. It's well, is this going to have generational problems? Is this going to be with us for 10, 20, 30 years before all of it's actually cleaned up?
Yeah, because I guess, I mean, it also comes back to this. They have no idea how much oil, actually potentially. First of all, I'll note that it is insane to me that somebody hasn't figured out that like BP hasn't invested billions of dollars into figuring out how to like stopper this leak. It's like not like oil leaks like never happen. It's not like this is really an anomaly. It seems like it happens every once in a while that this happens. And it's just sort of funny to me that they like have no way. It seems increasingly possible to me that they're just not going to be able to stop it, and the oil is just going to keep on running out. And like, a couple months from now, the pressure will equalize at the sea floor or whatever, and they'll, start taking it out from other wells. But the guy who I've liked reading about this very question of like what the economic liability is this guy David Kotok, who writes for Cumberland Advisors, and he has these sort of like kind of hilariously gloomy scenarios where he's like, the best scenario is a very bad scenario and it'll cost like a few $billions and blah, blah, blah. And like the most catastrophic scenario is that this is like actually going to cost like in the tens of billions, possibly even hundreds of billions of dollars. And that, I think that he predicted at the ultimate sort of end of that is that it'll force a double dip recession, which I don't think is true. But it's interesting because, there's no way to calculate, like the birds that they're going to kill and the marshes that they're going to kill. And I guess that there was like some concern, right, that this was also like a financial liability to banks. But I guess that BP just insures itself because it is so profitable. And what kills me is like it will still be so profitable. Like BP is going to have enormous liabilities on this, particularly if they take away that liability cap. But like oil remains a pretty good industry to be in.
Yeah, absolutely. And it's I will give a shocking display of confirmation bias because this confirms something I thought about the financialization of the economy, which was that you look back at BP statements and analyst reports and opinions about how the company was doing over the past 10 years, and you just Google right now BP, quote, cutting costs, and you will get tons of hits. And the market just loved the fact that BP kept its costs very low. And, on one hand, they were, cutting costs on labor. So, that translates into, poor union rights and, horror stories about workers being held on boats until they signed documents after this cataclysm and all this other stuff. But on the other hand, it's also, safety technology and, double and triple redundancy systems and research and development. That, when you have a market that's so short-term focused that it's very difficult to invest in things that have huge social benefits, but would cost the short-term, funds that own these things, a lot of money, or even just a little bit of money, which they get pissed about. So, it's obviously a role for regulation there, but it's also a role to kind of step back and say, when we are so focused on the stock price of these companies, what are we missing? What is not captured in those things?
Yeah, absolutely, and I think that you're precisely right, and it's crazy to think that like actually these companies, it remains just crazy to think that if you have an oil well, there's always the risk that it is going to leak, and so it's like it would be like the United States not having sort of like a system of firefighters or whatever. It is inevitable that things catch on fire, and therefore the United States has created this enormously elaborate system of fire hydrants. But BP, when it is inevitable that one of its wells is going to leak or there's going to be some sort of disaster. Like, it's just collective shrug. And what's the name of the thing that they're doing? It was some awesome...
Top Kill. Was it Top Kill?
Top Kill.
By the time this airs, Top Kill will probably have failed or succeeded. Do you want to guess? I'll toss a coin over here.
Oh, I'm saying it's failing. There's no way it's going to work. There's absolutely no way.
Will you give me odds? Will you give me odds, and then the viewers can call it?
If I were a betting person,
mm-hmm.
I would put like a pretty significant amount of money down that it doesn't. Maybe it stops some of it or whatever, but I don't see it working. I really hope it works because this is. I mean, yeah. I prefer my Gulf without like massive gobs of oil in it, but And actually, I wrote a piece about this when it first happened. Just sort of like talked to a couple folks about the issue of disaster, and this was one thing that was impressed upon me, is that this isn't really impacting oil prices. It probably will be very expensive to BP, but BP, owning an oil well is basically like being able to print money. BP will be fine as a company, I think. But yeah, it's screwing local economies. It's screwing the tourism industry. It's totally fucking with all the resources down there. So I shouldn't swear on podcast, but it is. And,
right.
And And it's going to be local businesses that hurt. It's going to be restaurants. It's going to be people who are shrimping. It's, you know, it's folks.
Communities with like terrible atmospheres and, you know, have to move all of a sudden. Like it's massively disruptive. And to me, it makes, you know, and in theory, maybe the guy you cite a lot kind of briefly touched on this was, maybe this would even increase GDP, like, because, you know, suddenly you have to spend a lot of money and this kind of almost stimulative way to like fix that. And it makes us have to step back and consider, like, okay, so when we put a dollar to everything related to global warming and the degradation of the environment, you know, again, what are we missing? Like, what is, you know, this might be a blip on our kind of aggregate charts, though it's obviously radically disruptive and welfare destroying for many people. And, you know, how do you measure that, or how do you think about that even? So.
Yeah. And I guess as a final wrap up, do you have anything to say about the Facebook privacy changes?
Facebook privacy changes. Yeah. So what actually creeped me out was when the guy from who's the guy who creates it? Zuckerberg, right? This Harvard guy.
Mark Zuckerberg.
He gave a quote that was hold on. Having two identities online is a sign of, quote, a lack of integrity. Did you catch him saying that?
No, I didn't. And I don't think that that's true.
He said that. I mean, that's a true statement.
Yeah. No. I mean, I disagree with his point.
Right. And I will put a link up to a friend of mine named Aaron Brady wrote this great thing about Du Bois and, you know, what it means to have two identities or multiple identities. There's like this basically all, you know, all these academics came out and tried to like outdo themselves with talking about multiple identities. But, you know, in the finance books, I wrote under a pseudonym for a long time. I was employed and talking about stuff that my employer probably would not have liked about the financial sector. And the finance blogs are notorious for pseudonyms and anonymous content, and, you know, from very respectable people to kind of the crazy people. But, you know, everyone quickly finds a way of knowing who to trust on what. And so it doesn't but that identity is way different than, you know, my identity I have for friends, and which is different than my family ones. And, you know, Facebook obviously collapses all that because, you know, I have my boss is my Facebook friend, my friends from college who have very embarrassing stories about me, and, you know, family and potential business partners and whatnot. I find it a very uncomfortable experience for that. Like, so who said that? Twitter is the opposite, because you can see people and not have them see you and stuff. Like, there's ways of managing who has access. Where Facebook's a very flat organization. But anyway, do you just think Facebook is just something we shouldn't worry about and we should just move on, or?
Well, I have to say that, like, my personal Facebook use, I like Twittering. I agree with you that my Twitter feed is public. Anybody can go see it. You know, I always Twitter as if, you know, with the recognition that both my mother and my boss could read it, as well as, like, the federal government or whatever. And in some ways that's easier, right? You know, I don't Twitter where I live. I don't Twitter my phone number. I don't do any of that. But it's nice, you know, it's a nice way. It's a great way to, like, be in touch and monitor things as a journalist. Facebook, first of all, I find it, like, too crowded. I agree that it is, like, an uncomfortable, semi-public, semi-private melding of, like, worlds that you don't necessarily want to collide. And I disagree with Zuckerberg's, you know, kind of idea that you should, you know, have a single unified identity on the internet. I think that that's, like, not true. And I was looking, I moved into my place, like, not actually too long ago, and I was looking through, you know, I have, like, a box of, like, really old stuff from high school, and I was looking at my high school Facebook, and remembering that when I was in high school, there was, like, this, like, sheet of phone numbers of everybody at school. When I was in high school, I didn't have a cell phone. The internet was obviously around, and I had, like, an email address and whatever, but you primarily got in touch with people by, like, calling them on the phone. And, like, it's crazy to think that, like, I'm a relatively young person and a good earlier adapter of these technologies, but, like, in my lifetime, it's changed totally radically. And so, you know, it's funny that I think that Facebook has just become like MySpace has also a site that I don't use. You know, one of these things where it does just become this question of, like, what you want online. And it's interesting that, like, the millennials have this sort of reputation for not actually putting that much stuff online. For recognizing that, like, once it's up there, like, it kind of, you know, can be hard to find, and you can be confused with other people, but it also doesn't go anywhere, and it's there, like, kind of forever in some sort of creepy sense. Yeah, so the Facebook privacy stuff, I don't have a lot to say about like Facebook as a company. And again, it's weird because I just like don't use my Facebook account anymore. I used to fairly often when I was in college, but ooh, sorry, I have a call waiting. That's never happened to me when I've been on the phone.
Um, well, I can talk for a second if you need to check it. But the thing that's freaked me out about Facebook recently is that I see it following me online now. So like,
Weird.
I went to a few web pages of newspapers that are popular, and on this, I'm scrolling down, and then on the side it says, so and so, there's a Facebook window at this other site, and it tells me about what my friends are up to, and it's that kind of like it's spatially, it's like a weird kind of feeling because it's like someone's following you, but it's a web page, like. It's like if you saw someone at a subway stop and then you saw them outside your house or something. It's
yeah, that is weird. Wait, so how does it work? Is it like if you're signed into your Facebook account, like when you're on like the newspaper site, it like somehow knows that? It's like
yeah, and it said, so and so, Rosario just said she, got lunch, and it was like right next to a blog on a webpage, and it was like really like whoa, and it made me realize that they're obviously disseminating this information quite broadly, and they're monetizing information, and they're like I kind of always assumed that Friendster, which I was on back in the day, I like going back and seeing my old Friendster and MySpace profiles because it's very much me, like from those time periods, like the music I liked and the way I tried to impress friends and stuff like that. Like it's kind of like having this like weird Dorian Gray picture that like never gets old while I get old kind of thing of me from like when I was 23 and 26 respectively, or whatever it was.
Funny.
But anyway, yeah, no, I kind of always assumed that they were heavily data mining me for my favorite musics and selling it to Dave Geffen, and it was all somehow turned into whatever Lady Gaga or something, and then but the whole like actually like giving my information out in a different like it just I don't know it's weird, and I don't think people have essentially I think you're right about the millennials. I think people are more concerned now. I hear people say, well, people have essentially voted. They're online. They use the internet. They know or at least suspect that these things are being traced, and they've voted because they use it. And I say, well, no. One is that people don't like talking about regulation and utilities, but one thing is that we're approaching a point where you have to be online, where it's no longer kind of a fun thing you can do on the side. It's essentially a new type of public sphere that you need some sort of protection to make sure that you can actually communicate in a way that's not exploitive to you. But that might not be relevant to Facebook, but I think in general that we're approaching that point quickly. But I don't think people have voted. I just don't know if people know productive ways of resisting that kind of exploitation yet. I don't think it's there yet. It may just be things you click on your browser, or maybe joining another site that's not Facebook. But I do think that's going to be a big debate over the next 10 years.
Yeah, well, I think it'll be interesting. I have this sense that Facebook, that there could be another competitor to Facebook, and the big reason that I think that people haven't migrated from it, and might not migrate from it, is that it was just there first, right? If somebody wanted you to go upload a whole bunch of photos of yourself and like detail a lot of personal information about yourself, Twitter is really easy to start up using. You just go and you write 140 or fewer characters and like you're there. Whereas Facebook, there's actually like some sort of investment in there, and like the more you're interested in seeing people's photos and kind of participating in it, like that's where the value is added. I feel like Facebook, it could just be that it would like die this sort of slow death where everybody would have this sort of like imprint from some time in which they were in college, and then. Although I guess that now, like, I have a fair number of aunts and uncles who use Facebook, and they really like it, and they really like being able to get in touch with people that they went to high school with there. Anyway, but I still have a sense of like Facebook as like kind of an evolving and possibly like ephemeral phenomenon. Whereas I have this sense that like Google will be around forever. And I think it'll actually be really interesting if basically because Google stores all of your emails in GChats, if like 50 years from now, like how different like writing your memoirs and how different memory will be because like everything will be in one place. And it's funny because all of my work email now is done through Gmail and I really, really love it. And this is my first job that I've had that it's all there. And so that will be pretty cool. But yeah, Facebook, I also think that like for a company like Facebook to sort of be thought of as like kind of like creepy or something could be a real death knell.
Excellent. It will start bleeding out users in the way Fannie and Freddie is bleeding out money and the Gulf is bleeding out oil. That's to recap our conversation.
Yeah. And with that, I think unless you have anything else to add.
Well, that was a good conversation. Thanks for taking the time, Andy, and I will talk to you soon.
All right. Talk to you soon, too. Bye.